Hello, and welcome to this weekly market recap for the week ending Friday, January 16th, 2026. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. And as always, it's a pleasure to be with you. Couple things worth noting before we get into the numbers and the charts and all. The most bullish period of the year historically since 1950 has been from the close on October 27th through the close on January 18th. January 18th, of course, falls on Sunday. So that period has now ended for the bulls. And that period represents, I think, almost 24% of the calendar days of the year. But it has represented more than 50, well, about 50% of the gains on the S&P 500 since 1950. So 24% of the year accounts for 50% of the gains. That period ended today, Friday, the 16th of January. So just want to point it out because we do have a tendency not to do as well once we get outside this period. We've seen many bear markets and corrections start during the months of January and February. And I think a lot of that is because it comes on the heel of such a strong period. One other thing to note about this period is that it tends to be a really solid predictor of the subsequent year, depending on how well we do. And we did finish higher. So this period did finish up a little bit more than 1%, but that still places us in the bottom quadrant of all October 27th to January 18th periods since 1950. So there's 76 years. So if we break them down, that would be 19 years in each quadrant. That 1% gain, or a little bit more than 1% gain that we just experienced, puts us in the bottom 19 years. Now, it doesn't guarantee us anything, but what I can tell you is that historically, the market looks ahead and the market loves to move higher during this period. And so when we go through a period like this where we barely budge to the upside, the tendency has been for the market not to do well in that following year. For instance, for all of the years, the 19 years that fall into this bottom quadrant, the average performance in the following year, so in other words, for 2026, since January 18th falls in 2026, what I'm looking at is for the year 2026. If we go back and we look at the other 18 years in the quadrant, the average annual performance in that subsequent year, minus 1%. That's the average. There have been a number of years where we've seen more than 10% declines. Obviously, we've had some years, I think the best year was like a gain of about 14% from what I recall. There might have been one a little bit better than that in the bottom quadrant. But my point is, if you believe in history or you believe in the market kind of forecasting ahead and looking ahead, then we should be lowering our bar of expectations. And that's what we've already been talking about. I started talking about this at the beginning of December. And what I said then and what I continue to say is that topping is a process. Even these last couple of days, the market's had some really nice gap ups, and we've seen some additional strength from AI stocks and semiconductors, but most of it was at the opening bell. We're not seeing a lot of follow through. And if you were thinking about, hey, what's the best way to get out of stocks? It's gapping them up and then having everyone else buying in and chasing that rally so that you can get out. I think that's what many of the Wall Street firms are doing. And we've been talking about this rotation. I'm going to talk about it some more today. I'm going to talk about it as long as I think it's worth talking about. And until the market proves me otherwise, I'm going to continue to basically to just express extreme caution in the market right now. I don't like this market. I don't like the way it's trading. I don't believe that all-time highs should be treated equally. I think some come with sustainability ratios rising, suggesting that we're going to go higher. And I think others come with a lot of warning signs. And that's what I'm seeing right now is a lot of warning signs. So anyway, we're going to get into all of that and go through a lot of charts with you here in just a minute. But let's go ahead and start off with the major indices for this past week. So the good news is small caps are absolutely on fire. And I'll show you their rate of change so far in 2026 in just a couple of minutes. But the Russell 2000, the small cap Russell 2000, completely annihilating the S&P 500 and the NASDAQ 100 so far in 2026. And I wouldn't be surprised to see that continue for a while. This is something I've talked about really off and on for the last couple of years, that I thought that the small cap stocks would play catch up. And I think to some degree, that's what we're seeing right now. But last week, Russell 2000 gaining 2%. The mid caps gaining 1.3%. Transports up 1/3 of 1%. The Dow Jones down about 0.3 of 1%. S&P down 0.4 of 1%. And then the higher growth of those large cap growth stocks that reside in the NASDAQ 100 falling almost 1 full percentage point. So you can see the difference there between the Russell and the NASDAQ just this past week, more than 3 percentage points difference in their performance. And again, that's been going on for a little while, and we'll show you that on a chart in just a minute. So moving on to the sectors, I'm just seeing a lot of value at the top of the leaderboard. You know, we've got 6 groups going up, and we have 5 going down. And of the 6 going up, we've got real estate, defensive group. We got staples, defensive group. Utilities, defensive group. Energy and materials, more value. Industrials, kind of aggressive / value. There's some value in many of those industrial names, many dividend payers and so forth. But that is one area of the market that I like to follow that typically at least keeps pace with the S&P 500, if not leading it during secular bull market advances. So I like the fact industrials are performing well, but the other 5 groups in the top 6 of the 6 that actually finished in the green this week, 5 of them are clearly defensive or value-oriented areas of the market. And so this rotation that I've been talking about for several weeks continues. Money is rotating away from many of the high-octane growth stocks. We'll pull up and take a look at the Mag 7 in just a few minutes. But you can see technology going along for the ride, about the same as the S&P 500. But look at consumer discretionary getting hit, down 1.7%. Financials, 2.3%. Communication services, 2.3% as well. And what's noteworthy here is financials. We started seeing the banks reporting earnings this week, and it was a mixed bunch. We had some banks that were struggling. Citigroup, I think, missed its revenues. I believe Wells Fargo also missed its revenues, if I'm remembering correctly. But then we had JP Morgan, which beat top and bottom line. Also PNC. PNC had a nice report and got a nice gap up. It's been one of the better performers this week among the banks, and I thought they deserved it. They beat on the top line, beat on the bottom line, and they raised guidance. So PNC Financial, I think, is one of the banks that may start to emerge going forward as one of the leaders in that space. But there's just a lot of rotation in some of these aggressive areas that given me some heartburn for sure. And you know, if you've listened to me for a while, you know I'm for the most part bullish. I don't like being cautious. I would rather just be outright bullish, talking about how great the market looks and how high we're going to go. That's not what I'm talking about right now. In fact, I think you've got to tap on the brakes. I think you better have your stops in play, because I do think if this market starts to roll over, it could roll over pretty quickly. So take a look at the major indices. So the S&P 500 just simply going sideways here. Down at the bottom, I put in this rate of change. This is a daily chart, and I have the 11 rate of change for 11 periods, which is 11 days. And that essentially is how many days we've had so far this year. And what I found interesting is that the S&P 500 right now, year to date, is up 1.38%. The NASDAQ 100, which has a similar looking chart, we haven't seen a 52-week high since, or an all-time high since the end of October, but we're close. We're up there close. But you look down here at the rate of change so far this year, 1.11%. So both the S&P and the NASDAQ, a little bit more than 1% gain so far this year. Now let's look at the small cap Russell 2000, And I think you can see that the gains here are pretty obvious. Easy breakout to all-time highs, going up almost every single day. And instead of going flat, like we saw on the S&P 500, on the NASDAQ 100, we're actually seeing a nice trend to the upside here in the small caps. And that bottom panel, look at the rate of change, 7.96%, almost 8% so far this year. 8% versus NASDAQ and the S&P barely over 1%. So I know a lot of folks not used to this. Small caps have underperformed for many years. It was probably 2021 was the last time that small caps really started to outperform like we're seeing right now. I think that this is a great area of the market to stick with until it proves otherwise. It's breaking out, trading above its 20-day moving average, which is above its 50-day moving average. All are rising. PPO's rising. A little bit overbought in the near term, so maybe we get a 20-day test. But I think this is the healthiest area of the market, or certainly one of them. So small caps, the IWM, if you really want to stay invested in the market, this is certainly one area I would consider. Let's take a look at the Mag 7, because it was interesting back during 2023 and 2024. A lot of technicians were saying this market's not healthy because the Mag 7 were leading the S&P 500 to the upside. The S&P 500 is a market cap weighted index, and these are by far the largest companies in the world. So yeah, these are the companies that if you're interested in investing in the S&P 500 or in the NASDAQ 100, these are the ones you should be the most interested in. Why is the NASDAQ and the S&P 500, why are these two indices underperforming small caps right now? Well, it's pretty simple. Let's first start with Apple. Apple topped at the beginning of December, and it's been going straight down. It's fallen from almost $290 to $255. It's pretty hefty percentage of both the S&P 500 and the NASDAQ 100. So it's going to have a pretty significant impact. How about Microsoft? Microsoft topped all the way back. This was all the way back at the end of October. We're up at $550 a share. Now we're at $459. We've chopped off almost $100, and we continue in a downtrend. Recently breaking down below a triple bottom, and we had a bear flag in play prior to that bottom, or prior to that breakdown. So this one doesn't look good. How about NVIDIA? NVIDIA, you say, well, it's not trending down. That's the good news. The bad news is NVIDIA relative to the semiconductors is about to move to a 52-week low. So semiconductors continue to move higher, but it's smaller and mid-sized semiconductors that are moving higher, not the big ones that drive the S&P 500 and the NASDAQ. So here's another problem. How about Meta? Meta's been under a lot of stress. Just recently broke back down below 640. I think potentially could be heading back down toward that 580 level where it bottomed back in the month of November. Not looking good. Google, this is probably the best of all the Mag 7 stocks, and it looks like it might be ready to roll over here a little bit. AD line looks good though. Relative strength looks awesome. I would say this is the only Mag 7 stock that to me is really healthy. Tesla's starting to roll over. This is, maybe the second best. You could probably draw a trend line, and we're still kind of hanging on to the trend line, but we are below both the moving averages. You've got the 20-day moving average coming back down. We don't want to see that death cross below the 50. That's something to kind of keep an eye on. And with this move to the downside, you can start to see a little bit more deterioration in the AD line, which we didn't see on the last move down. This was back in November when we took a pretty big hit, and the AD line stayed up pretty close to the high. This time seems to be a little bit different. So we'll see whether or not Tesla continues to hold on to that uptrend line. Amazon got up to 250, which is where we failed back in November and started to roll over. So far, holding the 20-day moving average. I think that's going to be a big level to watch on Amazon. Those are the 7 big Mag 7 stocks. And to be honest, they just don't look very good. And they make up a big portion of the S&P 500 and the NASDAQ. So I mean, we can get all the breadth and everything we want, but if we're not getting performance out of the stocks that drive the S&P 500 and drive the NASDAQ, we're in trouble. And if those other stocks start to roll over and follow suit, that's when I think you could start to see the indices really begin to drop. Now, again, I'm not bearish at this point. I don't turn bearish until the price action turns bearish. I turn cautious. And, I get questions from time to time like, well, this one sustainability ratio has been weak for several months. Why only in the last couple months have you turned more cautious or bearish? And I would simply say that as we have moved on over these last several months, more and more signals have turned bearish. Just like the one today I'm talking about with the most bullish period of the year just ended. January 16th, well, January 18th normally, but that's Sunday. So January 16th, today's close, that's it. The most bullish period of the year just ended. That's another check mark in the bears column. We're moving into a part of the year where we don't typically see the kind of bullish action that we usually see in the period we just ended. So something to think about. Now, I'll give you a couple more stocks. Netflix, another pretty big one. You can see Netflix. Look at this, just continue. It's like a ski slope right now here on Netflix. And how about Broadcom? Broadcom's another semiconductor. Doesn't look too bad going sideways, right? Well, it just moved down to about a 6-month relative low versus the semiconductors. So when your biggest stocks are not leading the group, it's going to be hard for the market to go higher. I mean, something needs to happen. Some of these Mag 7 stocks need to start, changing course, or the S&P 500 and NASDAQ going to be it's going to be a big struggle to try to go higher without these stocks going along for the ride. Now, I want to show you this rotation. I've been showing this a lot, and it's getting worse. Even though the market went up last week, and we set some new all-time highs on a couple of the different indices, the under the surface signals are getting worse. Here's the spider. This is actually the QQQ relative to the spider and how they have performed during the trading day, ignoring gaps, 9:30 in the morning till 4 in the evening or afternoon. We've been going down for several months now. Not great. And even if we include the gaps, we're about to break down to a multi-month low, about a 2.5, 3-month low. So that's not good. But worse than that, in my opinion, is the way consumer discretionary is performing versus consumer staples. We just posted another new low this week on the intraday. So again, we're seeing some gap ups in like the XLY relative to the XLP. And that's what held up. This is the one that includes the gaps. So this has held up a little bit better than the one you're looking at the top, in the top panel, because the top panel doesn't include any gaps. Bottom panel does. So the bottom panel doesn't look quite as bad, but these gap ups could be allowing Wall Street to move away from some of the more aggressive discretionary stocks and moving into the more defensive staple stocks. And that's a problem. A risk-on market environment is what drives secular bull markets higher. You can make all the excuses you want about breadth and the participation in this rally broadening and all this stuff. If you go back and you look at secular bull markets and what drives them, it's growth stocks. That's what drives bull markets. It's because they can expand their earnings so much more rapidly. It's great to see some of these other stocks getting a lift, but it's not helping the major indices because many of the growth names, especially the Mag 7, many of them are under pressure right now, selling pressure. And then when I see intraday money rotating away from discretionary and into staples, it's starting to paint me this picture that Wall Street is turning more defensive, the big Wall Street firms, and that almost always happens before a decline. So listen, you don't have to believe me. Only thing I would suggest is keeping your stops in play. because if the market starts to roll over and we see another 2025 where we ended up going down 20%, or a 2022 where we ended up seeing a lot bigger decline, S&P went down 28%. I think NASDAQ was down about 38%. I don't think we're going to see that, but we really don't know until we start to see the decline and how the decline unfolds. So I'm just cautious, and I'm going to remain cautious for a while. These signals don't change overnight. Anyway, this is a more bullish chart. This is the IWM, Small Cap Russell 2000 ETF, relative to the QQQ, which tracks the NASDAQ 100. Look at this intraday. It is screaming accumulation. So as money rotates away from the Mag 7, small caps are getting a lot of this money. And so that's why the IWM has been such a great performer so far. And until things start to change, I would stick with small caps. All right, for those of you that are new to Earnings Beats, come on over to our website, earningsbeats.com. Got a couple things for you. First of all, you should be signing up for this 30-day no-cost trial. If you haven't already, come on board and check us out for the next 30 days for free. You will have to provide a credit card, but we will reach out to you before you get charged to let you know that your trial period is ending, and we're going to give you a great offer for an annual to save you a lot of money, an annual membership. So check this out, because I think the next 30 days could be critical in the market. We issue daily market reports to our members. We provide chart list, watch list, potential trades. This would be a great time to have somebody watching over your back, because this is not, I don't think this is a very friendly market right now. Anyhow, if you are new, completely new, and you just want to learn a little bit more about us, we've got a free Earnings Beats Digest newsletter. This is completely free, no credit card required. Name and email address is all it takes. Literally, we've had tens of thousands of folks join us. And why wouldn't they? I mean, we're trying to provide good information, valuable information for free, very educational material, talking about how we trade, some of the things that we look for. Hopefully, we can help improve your trading results or investing results. Be sure to check that out. All right, couple of chart lists at Earnings Beats that we have that I think, I don't know if they're overlooked. This one probably isn't. This is the strong earnings chart list. I feel like this is our flagship product at Earnings Beats. We do a ton of research. I'm a former practicing CPA, so I think the fundamental side of the business of trading is really important. I don't buy stocks based on fundamentals, but I do put them in watch lists based on fundamentals. And then I buy them based on technicals. So if you're going through here, what we do is once a stock goes through and it beats Wall Street estimates, top and bottom line, if it's a liquid stock and either it's a leader in its space or maybe its space is showing strength, we'll include it on this chart list. And we usually will identify one or two support levels on the chart. So every chart on this list is annotated. We have over 500 charts on here. And so like today, State Street reported really good numbers. This is an asset management company. They reported great numbers, but it was a buy on rumor, and now it's selling on the news. And so I identified a couple of key support levels where if we go down and we hit maybe a certain support level and we get a reversal, a hammer, something like that, might set up as a great trade. So this is just a disciplined way to try to exercise patience. If you're chasing in a market that tops, you're not going to be happy. And again, I can't guarantee you it's going to top. Maybe the market goes up all year. I can't guarantee you. All I can tell you is based on history, the different signals that I'm seeing right now are very consistent with topping patterns or topping periods in the stock market. And so if you're going to trade, number one, try to trade stocks when they get to support. That way, if they fail to hold support, you can exit quickly. So, I mean, I could go through and we could just pull up. Here's PNC. This was the gap up. You can kind of see PNC has really started to trade well. Look at the relative strength. It was at a 52-week low 2 months ago. Now the relative strength has been picking up, and we found out why with their earnings report. They beat top line, beat bottom line, raised guidance. This is what Wall Street's finding out when they go and meet with management teams. We find out by following the money and following this relative strength. So anyway, PNC looks good. I could go through all of these, but I want to show you a couple others. So here's the raised guidance chart list, which, by the way, PNC is on it because they just raised their guidance. So it just got added. But all the stocks that have raised guidance are also shown on here. And like this ONDS, I don't know if it holds on to this gap support, but recently it gapped up and came back down today and tested it. So rather than chase a stock like this at $14, $15, we know gap support's down closer to 12, and actually probably could put in another line maybe here at about 11 and a quarter, 11 and a half. That was the prior high that we saw a few months ago that we took out. So that'll provide some support on the way back to the downside. So the whole idea is just to be patient and try to allow some of these stocks to come back to you. Here's a stock. QMCO has been, this is Quantum Corp, been going down for a while, raised guidance earlier this week, gapped up, and now it's got gap support. Actually came down and hit gap support yesterday before moving back up and gaining about 7% after hitting gap support. So if you got, again, you like stocks, they get good news, they gap up, wait, let them fill that gap, come back down to a key support level. And then here's this I want to just mention. This is our bullish trifecta chart list. And what this chart list does is it gives us all the stocks that are on the strong earnings chart list, the raised guidance chart list. Those are the two I just showed you. And then also the strong accumulation distribution chart list. And so any stock that is on all three of those chart lists then get added to the bullish trifecta chart list. So this is, these are obviously companies that have a lot going for them. Fundamentally, technically, and you can see here this is the AD line. So the strong AD is just a company that shows consistent strength in its AD line, meaning that it tends to close pretty strong most days in the afternoons. Anyhow, I think there's probably like 70 stocks on here right now. So all of this information you get constantly. We update this every single week for our members. So take some time, go back, try us out for 30 days. See what you think. Let us help you get through this period because I do think it's going to be a rough period ahead. We'll see just how rough we're going to find out. Anyhow, that's about all I have for today. Please, if you like our video, hit that like button and also subscribe to our channel. We do a lot of live streaming shows from time to time. So if you are subscribed and you turn your notifications on, if we do a show, YouTube will reach out and let you know, and you can join us. Anyhow, have a great weekend. This is a long holiday weekend, so the market's not open again until Tuesday. A lot of football coming up, NFL, college playoffs. Should be a great weekend for sports. Enjoy the weekend, relax a little bit, and we'll be back at it on Tuesday. Happy trading, everybody.